From a contrarian standpoint, there are signs that we're nearing the bottom of the adjustment process here. And unfortunately, it often has to end with a credit cycle, and we're beginning to see the credit cycle in the old super cycle industries where there was a lot of malinvestment. We're beginning to see a credit cycle in China as well. They're being greeted as negative, but that's actually part of the positive clearing process. Expectations are falling, earnings growth expectations are falling. We've got a story, a narrative, secular stagnation, and kind of embracing the pessimism. At the same time, what you want to see is people ignoring good news, what in behavioral economics they say the underreaction to good news, and we're beginning to see that where growth is actually picking up in Europe. Consumer confidence is picking up everywhere. Signs that the housing market is improving in both China and Japan. So we're seeing a lot of ignored positives and that kind of end of cycle negatives towards sentiment that normally mark the end of a period of adjustment. From a contrarian investor standpoint, it's still a challenging environment, and we always go back to the tenets of our philosophy, which is we can't forecast the future, we're going to be wrong sometimes, and we have to benefit from uncertainty. So there's two things that we can do tangibly in every investment we make in an environment like this. One, demand a sustainable and strong balance sheet, because we don't know how long this goes on. It could get worse. We don't think it is, but we want to make sure that our companies are prepared to survive and thrive. Also, we want internal growth drivers, innovation, new markets, cost cutting. So the macros can get better. The macros can stay as they are, or they could get worse. It's nice to, as best as we can, take that out of the equation with internal growth drivers. So a lot of new technologies, a lot of new markets, companies that are reinvigorating themselves with either an acquisition or a divestiture. So all of our investments have strong growth that isn't dependent on macros. It can be helped by a stronger economy, but not dependent, and the balance sheets are outstanding. We do think that the new China and the transition in China that's still ongoing, and think where it's going as expected and in going about as well as can be expected, is still an important driver for growth. We're going to see the positives of this unfold a bit more. We've seen the negatives in the manufacturing sector and commodities and energy demand as their economy becomes less energy intensive and less commodity intensive. The consumer side of China is continuing to do very well, and we think it will continue to do well. So the idea is it's critically important to get China right, but that doesn't mean to avoid China, as many people are now, and the opportunities caused by the pessimism in China right now are just fantastic. We're in front of the new Silk Road, or the One Bridge, One Road initiatives that we're going to see. We think we're going to see, just in the last few days, we saw them decrease the down payment required for mortgages, mortgage rates plunging, and we saw them decrease the tax on automobile demand. The last time they did that, auto sales jumped 50%. So it's probably maximum pessimism in China and time to focus more on some of the structural transitional growth initiatives. Japan and Abenomics basically is going into another phase. The low-hanging fruit's been picked, the focus on ROE. We know quantitative easing has been done, but the real fundamental focus on improving corporate governance and improving profitability. Japan has record high profits. They have the best profit and dividend growth in the world. I think people have gotten that now. So things are really getting pretty dynamic there, which is, it's been a long time since we've been able to say that about Japan. Europe's actually the shining economy story during, but it's hard to believe, isn't it? But it's actually the economic star right now from a rate of change standpoint, with very good economic growth, loan demand growth. I mean, even France is beginning to grow, and they had been the big laggard. Money supply growth is 5 to 10%, depending on which M you're looking at. So we're seeing strong demand for autos, construction, consumer demand, growth in the periphery. Earnings are beginning to rise, even though there's substantial room for improvement still. Europe took on kind of that most improved award for the quarter and continues to drive positive economic surprises and do well. Underweighting in energy helped. and also our position in energy stocks was not focused on energy producers, but some special situations there, specialty product tankers, people that were focused more on the pollution control and efficiency side within energy. That did quite well. Also, it was a good quarter to have some defensive weighting, so our staples did well. We have a lot of restructuring companies and companies with some pretty interesting focus on like organic food. So a lot of growth helped in the staples area. All of the negative performance in our portfolio came from emerging markets and those consumer-oriented companies, domestic demand plays in emerging markets, which continue to do fundamentally very well. We didn't see any deterioration in fundamentals, but we did see people worry about the emerging market consumer. There's two big questions from a macro standpoint. One is the China transition, and will they be able to transition in an orderly fashion, and who gets hurt and who gets helped? I think that's shaking out. And that's going to stay a question, but we actually think there's going to be some positive news on that front. At least it won't get worse. The other big question is, are the developed world central banks and governments going to be successful in decreasing the burden of their unfunded liabilities? They're going to do this by debasing their currencies, by inflating, by creating some inflation and some growth. The credit cycle that we're going through is necessary. We're going to have to take a lot of the malinvestment and the poorly run companies and the poorly positioned companies in commodities, in those areas of the super cycle. The bear market in bonds, people are going to start recognizing they haven't made money for 3 or 5 years and they're losing money now. So interest rates could begin to rise. Those are the unsettling aspects that we'll be churning through. The macro outlook towards China and some of the growth initiatives that are really going to start taking hold in Europe and throughout Asia. Those are the positives. And so what we see is maybe a bit more of a positive pro-cyclical tilt in the fourth quarter, and a bit more of a relief rally. Nothing, not 15 or 20% up, but maybe something, single digits, get back some of what we lost in the third.